How do index fund ETFs actually work? Imagine trying to follow a recipe that includes hundreds of ingredients. Instead of buying each one separately, you buy a pre-made mix that has all the right ingredients in the right amounts. That's kind of how index fund exchange-traded funds work. They are investment funds that aim to mirror the performance of a specific market index, like the Standard & Poor's 500. These funds hold a collection of stocks or bonds that match the components of that index. The goal is to give you the same returns as the overall market, minus a small fee. The process starts with a sponsor or fund provider who chooses which index to track. They then decide how to replicate that index. One way is full replication, where the ETF buys every security in the index in the same proportion. This method works well when the index has a manageable number of securities. When the index has thousands of stocks or includes hard-to-buy assets, the fund might use sampling. This means it holds a selection of securities that closely match the index's overall performance, saving costs and making trading easier. ETFs are bought and sold on stock exchanges, just like individual stocks. You can buy or sell shares anytime during trading hours, which gives you flexibility. This intraday trading is different from traditional mutual funds, which only settle at the end of the day. The price you pay for an ETF share is based on its current market value, called the market price, which fluctuates throughout the day. Most indexes are weighted by market capitalization, meaning bigger companies have more influence on the index's performance. For example, if a large company's stock rises, it impacts the ETF more than smaller companies. Some indexes use other methods, like weighting based on dividends or growth potential, to shape their composition. For African American retirement strategies, index fund ETFs are a smart choice. They usually have lower fees because they are passively managed, which means less money is spent on active buying and selling. This helps your investment grow faster over time. They also provide diversification by spreading your money across many companies, reducing the risk of losing everything if one stock drops. Plus, ETFs are accessible because you can start with small amounts of money, sometimes even fractional shares, making it easier to build your retirement savings. They are also tax efficient, meaning you might pay less in taxes compared to other investment options, helping your money stay invested longer. Understanding how index fund ETFs work helps you see how they can fit into your long-term wealth-building plan. They offer a simple, transparent, and cost-effective way to invest in the overall growth of the economy. By choosing ETFs that track broad market indexes, you can grow your retirement savings steadily, keeping costs low and risks manageable along the way.